Hello and welcome to Big Deal. Now, as we step into the new year, I have with me in the studios a big investor in the Indian markets, in Indian companies as a growth capital. I have with me Sanjay Nayyar, who heads KKR in India. Sanjay, so good to have you on CNBC TV 18.
Thank you.
Now, as we step into the new year, there are many factors at play. We have had an extremely active 2018. What are the factors on your radar when you look at India holistically in the year 2019, especially when it's also an election year?
So look, I think from our point of view, the main thing is growth, okay? This is a country where you underwrite deals and invest behind entrepreneurs for growth. So growth is key. Growth has been lackluster in the last, I would say, 24 months in specific companies and industries. And I would say, you know, in fact, there was an article somewhere I read where corporate profits have actually slowed down quite significantly, whereas market caps have still grown more than that. And the nominal GDP actually is probably about 12.5%, 13% growth rate. So if you look at the GDP, market cap, and corporate profits, it's in descending order. So when that happens, I think it really begs the question, why are corporate profits not growing as fast? So what matters to guys like us is that you end up, unfortunately, overpaying, given where the markets are. And then if the underlying growth is not as strong of the companies, while the GDP is in better shape, market cap is growing, you know, of the stock market. And I think that's the thing that we are most focused on. As we underwrite future deals and current portfolio, how do we make sure the companies are really growing in a better way, doing good business the right way? We think the effect of formalization will play through now. So we have to hang in, basically. What I'm saying, we've not had a terrific year in terms of just the value creation in our portfolio, but if you've got the right entrepreneurs, the right promoters, and the right business models, I think the growth will come now.
All right, you've backed many promoters in the past, and of course, corporate earnings is something that you mentioned. But when India is put in the global scheme of things, there's just so much happening. There are growth concerns overseas in the developed countries, and there is a tariff war playing out. Crude has its own mind right now. In the scheme of all these developments, how is India poised in your view?
So I think you heard Henry when he was here. If you were just to look at the list of worries around the world, there's a hell of a lot of them, right? And I think you just said a few. So if you just sort of fast forward and come to India, I think our worries are far lower than that. Because we are a very big domestic economy. We have our own set of domestic issues. But I don't think we are negatively impacted by that much of what's happening between US-China and the US issues, or the Brexit or Europe. I think we're affected by 3-4 things that we can't ignore, because you know we are a part of the global world. One, I think, is the US-China trade war. If that does become a bit more real and beyond just the kind of the caustic
Though there are
remarks
conciliatory talks, right?
Yeah, there are. But I'm saying if it does become real, then I think India could actually stand to benefit, because a lot of global supply chains will look to India, just as Southeast Asia. And India will have to capitalize on that opportunity. It just won't come in your lap, right? The second thing is that a volatile dollar does affect us in terms of the capital market flows. And I think we have seen the effect of that on our markets, because you know we depend quite heavily on the dollar flows. So, you know, and of course the final one is oil. We believe, you know, oil will be around the $60 range, which I think is a kind of number that Indian fiscal and current account deficit could live with. But we'll have to be watchful of the volatility in the dollar as well. That's a pretty important thing from our point of view. So, you know, if you drill all this down, if India could get its own, you know, house and continue to grow, make doing business in India easier, which I think things are improving a lot. And as I mentioned, the formalization of the economy is taking shape. It takes a couple of years to get there. Corporate profits could grow, and reinvestment in the business could happen. The public expenditure continues, which it has been very strong with this government to keep the public capex going. I think we will look very, very good 12 months out.
All right, so you're still putting that 12 months kind of a period. But as we start 2019, Sanjay, how do you see India at this point, and how are you assessing it as an investment destination?
In terms of availability of capital, there's very, very deep pockets available. Today, global investors are giving firms like us and a lot of our peers a lot of long-term money, and this is really long-term money. So I don't think there's any dearth of flows. There is no doubt that we invest out of an Asia fund, so we have to compete for valuation and returns. I would say India is right up there for a couple of reasons. One, for the reasons we discussed. It's still an economy which has huge amount of growth potential, an economy that is looking much better governed, and hopefully the reforms will sort of play its way through. And hopefully with the new government in May, you'll have even more structural reforms, and we can talk of that. So I think we don't have a problem on that. I think we do have a problem on a volatile rupee. It does hurt us. And so we have to be a little mindful of that. That means we have to underwrite to higher returns, because you have to give up a lot on the rupee depreciation. But I would say besides that, we have a huge team on the ground. We have a brand that is developed here. We know the entrepreneurs. We are in the middle of lots and lots of interesting corporate finance dialogue to help corporate India, in some cases repair and grow, in some cases just grow, in some cases internationalize. So we're in the middle of all of that. So I think from a perspective of being active in India, I mean, we're going to be as active as we've been before.
All right, so you'll be active, but Sanjay, if I look at your portfolio, you had some great exits over the last few years, but unfortunately right now you are poised for more investments as far as pure private equity is concerned. And at that time, rupee is not really favoring you. If you were making probably exits, then obviously it was not a great time at all. Given all this, how are you looking at further investments? You just did Ramki. You are looking at expanding probably your hospital business, and you are also looking at overall financial services space. What is it that is occupying most of your time and mind space?
So I'm not going to comment on any deal, as you know, but I think what's occupying our mind space is just working very closely with the companies that we have invested in. That is paramount importance right now. So whether it's the financial services platform, the media platform, the healthcare platform, and the waste management is yet to close, but we're already working extremely closely with the promoter and the management team. So right now, number one thing that's keeping us occupied, besides working on 1 or 2 deals that are in the pipeline, is just working extremely closely with the companies, and really helping the management and the entrepreneurs with filling management positions, improving operations, in many cases, getting them financing from overseas. And one thing that has actually gotten us even more busy in the last 1 year has been tuck-in acquisitions. Now, all these platforms of ours are actually platforms where you're backing fantastic entrepreneurs, right? Look at the healthcare one we have with Abhay, you look at Emerald, you look at Avendus and the 3 founders. And if you're there behind them and they're running a business well, you have so many tuck-in opportunities. So while you're growing organically, there's a lot of inorganic activity, and that's one thing KKR can help with, right? I mean, we come from a corporate finance background. We can help our entrepreneurs think about what risk we are taking with what kind of rewards. So that's keeping us really busy. So it's just the portfolio right now, and hopefully 1 or 2 new deals in the next 6 months.
All right, so new deals, but credit business, that's also something that is on top of your mind. You had some new hirings also to give a more focused approach there.
So credit, remember, it's the second leg of our So we have private equity leg and we have the credit leg. So on the credit side, we are extremely overcapitalized. We are very well funded. But with the PCA bank issues of the last 12 months, the IBC having taken shape, and banks actually sort of withdrawing from business, it has slowed down the credit business as well. Because you can't be the only NBFC or a few of us working in the market when the banking system itself is coming to a bit of a halt. So I think the business volumes have slowed down a little bit. But we think as an alternate lender, we should be one of the most preeminent in this market. Banks will have to play their role. Corporate bond market is non-existent. It's not going to come around in a hurry. So I think we have a very, very big role to play. So the team we have hired is just to focus on the NPLs, because we are going to tackle the NPL business in a very, very strategic and focused manner. Because with the IBC, I think we're seeing a few things that are becoming quite evident. One, I think promoters are going to be very serious to settle.
Yes.
Well-meaning promoters want to try and retain their companies, don't want to be defaulters. Banks have realized if you go to NCLT, you know, you sort of lose control over your destiny. The outcome may or may not be right in terms of what they get back. They want to settle outside NCLT. With all that together, and our ability, or at least we think we have the ability and we're building our capacity to transform companies, I think this is the time to be buying some very interesting distressed assets. So that's our kind of two big legs, private equity and credit.
You've always been keen on the stressed assets opportunity that is being presented right now, but not many funds, and not just KKR, not many funds have really stepped in this direction. Even though they are keen, they're still sitting at the fence.
I think it'll start now. It'll start now. It'll start now if we continue to believe and the banks continue to really, you know, really sell the assets at the right market price, and they get cash, not SRs. And if that happens, I think this activity will start.
Okay.
If the banks finally, you know, again, brush the problem around the under the carpet, and let's hope we have a lot of liquidity again, and you know, problems are gone away, then I think this problem will fester for longer.
I don't think that's going to happen.
I don't think it's going to happen, but I'm just giving you the other side.
From the lenders.
Yeah, I'm just hoping that.
Yeah, so will you jump into IBC processes, or is it outside of NCLT that you're more focused in?
I think outside NCLT is the first preference, but no, we look at all the IBC cases that fit into our kind of size criteria.
Any particular strategy when you look at these stressed asset situations?
The only one is that, you know, in some of the very industrial assets like power assets and steel and others, we will try and tie up with some strategics so that we have a real operating partner with us.
Right.
All of these are not really, you know, in our pay grade to go and work them around. So we'll have to partner with some people.
All right. And which are the sectors which you're more keen on? You have investments, have shown interest in cement in the past, and you have capital-intensive sectors in your portfolio as well. So you won't shy away from some of the heavy hitters in these segments.
Yeah, I think sector-wise, there really isn't anything. If I had to, you know, maybe wager one guess, I would say look at something in the IT services world. It's a good dollar hedge as well. Good to have a business that has got a significant amount of exports. Could be pharma, could be auto components. All these sectors have quite a bit of exports. So I would say that's, I mean, I do have a inkling that that's something we should really push forward, right? Okay. Like we had in Gland Pharma and in Alliance Tire, we had a lot of exports, and that in a way gave us a natural hedge. But otherwise, we are not focused as much on sectors as on situations.
Yes.
So we are really in the middle of situations. And today's situations are many, right? I mean, the big conglomerates who want to look at non-core assets. There are succession planning issues, and many of these assets are becoming available because people wanted to go in hands of private equity or strategics. And then, of course, there's a leverage one, where people are over-leveraged and they need to sell something to get something. So I think we're involved in more situational issues than just sector focus.
Now, let me shift focus and talk about the NBFC in particular. Now, you have a presence there, and we have just come out, or optically it looks like the NBFC crisis may have eased off a little. How do you ascertain the situation here? You are in the business, you have been lending to the real estate sector. Many who have been big critics have also mentioned that NBFC AQR should be done, and probably real estate will get a big hit if that is done. Which side of the debate are you in?
Look, I think the NBFCs may have brushed a lot of the credit issues under the carpet, so I think they need to be looked at. So I'm absolutely in the camp. Let's do a real AQR on the banks, and let's do a real one on the NBFCs. Okay, but real AQR. So that's number one. As far as NBFCs are concerned, I think it's pretty clear now. They're going to be the NBFCs that are well governed, have the right business models, the right funding plans, and the right liability structure, and those that don't have. People who are just sort of spinning a big story that they can grow at a massive rate and have X kind of leverage and, you know, Y kind of valuation, I think those days probably are over. There is a structural correction going on as we speak, and I think that correction is for the good. I mean, how can you have things trading at 4 or 5 times book value when the net interest margins are barely 1%? So I think that's changed for sure. So I think when this settles down, private equity capital will automatically flow towards those that are better on the scale of ROE, sustainability of ROE, and the whole funding structure, which is not necessarily in the ROE. So we'll be very clear about that. I think the second thing is that which NBFCs are competing on what basis. I mean, there has to be a sustainable advantage the NBFC has. And I think that's a big question mark for a lot of people, including for us, as we look at diversifying our business, to say, oh, we'll get into housing business and do what, right? We'll get into SME financing. How do you compete with these big banks, right, who have a massive advantage over us? They have the current account, they have the working capital account, they have cash management, they do export-import for these guys. You know, how can we just come and capture that space? So I think NBFCs will have to ask themselves, what is their sustainable advantage and why are they doing what they're doing? And can that sustain against a banking system, private and public, reinvigorated with a massive advantage of funding cost? So I think that's the big question. And that's why when I think about diversifying our business, I keep asking myself, we'll diversify, fine. But, you know, what are we getting into? Because what we do very well. Structured finance, we understand very well. Structured credit on real estate, we understand well. And that's a space, by definition, is non-banking. Banks can't do it. Or even if they could, I think we'll be nimbler. As NBFCs as a whole, we are nimbler, we are faster, and probably more sharp on risk. So that's an area I think we will definitely keep building. So
easier regulations also, and not coming directly under the RBI scanner, also gives you that advantage.
Yeah, it does. Yeah, that's absolutely. I mean, you get that formalization. Absolutely, it does. Yeah.
All right. So at the moment, is the matter a little worrying as somebody who's in the NBFC sector, and how do you see the outlook going forward?
As I said, we're not worried about our stuff. The question really is that, will the valuations correct, and then will there be enough credit flow to the NBFCs and equity flow to them? I think that's key. And I think the valuations are getting corrected. If they become very attractive, you know, we would like to buy some NBFCs ourselves.
Okay, so does this give you enough opportunity, and what is it that you look out for?
Too early right now. We are looking for things to tuck into our own financial services business, ex-private equity. But I think we'll do it, as I said earlier, with a little bit of caution, you know. Not by just doing DD of the business diligence, but why are we buying that business, and how does it fit into a grander plan? Can this company over time be diversified enough and differentiated enough to get maybe listed or whatever? Otherwise, just buying for bulking up, we don't need to do.
All right, so listing, that has been talked about internationally also, about your plans of going public with the NBFC space. Now, how is that really maturing? What is your strategy when it comes to having a wholesome portfolio there? And is that going to be different from your investee company, Avendus, that is also probably planning for a listing?
I think firstly, between Avendus and KKR, just to be clear, there is just no linkage from that point of view. Avendus is run by Ranu, Kaushal and Gaurav, and we are an investor with them, a significant investor from our fund. So we work with them like an investee company, and you know, they have to build what they have to build, and I think they are on a fantastic journey. So they'll have their own plans. As far as we are concerned, ours is a permanent vehicle. I think we like permanent vehicles. We are one of the few permanent vehicles in the KKR world outside of the US, and we would like to build a permanent vehicle into a vehicle that one day can exist for perpetuity, and I think listing is a great route. But there's no imminent plan. I mean, the way we are today, what we do is so institutional. I think it's tough to get it listed, and why should we list? You know, we make a very good ROE. We clip away our coupon, as they say. We don't have to list it right now.
But it's a long-term plan.
Absolutely. I mean, long-term plan, absolutely.
So, Sanjay, at the present moment, how important is easing of rules for the prompt corrective action banks?
Easing of the PCA rules?
Yes.
You know, I don't know. I think what has happened is they've put the banks into, as I call, under administration without really having a game plan of how to, A, get them out of it, or B, what is their role? Because a lot of these PCA banks are now becoming a bit of an obstruction in the consortium of lending. So neither are they able to lend, nor are they able to let you lend. So, you know, it's sort of, if your company has a couple of PCA banks in the consortium, I think they're stuck because, you know, they're not able to maneuver and do anything. So I think the RBI will have to look very hard. I'm not saying for a moment that you just go release their PCA banks, but, you know, they have to be, you know, if they're not meant to lend, that's fine. But then they let the better banks or NBFCs lend to their companies. Otherwise, the companies are just going to go down right in front of our eyes.
The NOCs are not coming. To put it simply, the PCA banks themselves are not releasing funds to their exposure companies. And not just that, those companies are also not getting an NOC from these lenders for others to give them money. For
either better banks or new NBFCs to give them money. So just think of it. If you have a mid-sized company and you have maybe had one defaulting interest rate or whatever, and there's a PCA bank, you know, who's not able to give you more capital. In the old days, you know, you could sit with your client and you could restructure. I mean, restructuring is a part of banking, okay? It's not something that is so bad. Now, I think the whole temperament right now is, you know, we can't restructure anything. The PCA banks are even further strapped. Neither can they restructure, nor do they give you NOCs, nor can they release the money. So think of this 1,000 crore company. If it's even growing by 10%, it can't get additional working capital. It then probably cuts its own supply chain, which is a smaller SME, who cuts it further, who has a smaller SME behind it. And that's exactly what this vicious cycle is. And that's when you begin to lose jobs at the bottom of the pyramid. And I think this impact we need to really, really fathom and tackle very quickly. So hopefully the RBI will attack this problem. Again, I'm not saying let the PCAs go, let the PCA banks go, but let them lend, have a new circular out, new regulations, or maybe recap the banks. But
there's enough clamor for relaxation of these norms, and RBI is working on that. And we are closely watching that as well, Sanjay.
Otherwise, you know, my only point I want to make is if you don't do that, you're actually creating NPAs out of non-NPA situations. And that's my worry here.
All right, fair point, and that's an important point that we are focusing on. All right, talking about some of the other areas in terms of the NBFC situation and the financial services, you had been interested in probably an asset like a Shriram kind of an asset in the past. You had also bought a minority stake in Bharti Infratel in the past, where the chances were that you will go further with those. Now, those themes stalled because of many changes in the market conditions as well. Where are we when it comes to taking these large bets based on large mergers that you are looking at?
We should do it next year end.
That's why I didn't ask you in particular about when
we'll talk about them. I'm not going to comment on the companies. Look, you know the rules. It's pretty straightforward. We aren't going to comment on any of this. But I just want to leave you with the thought that, as I said earlier, we are, I think, good at working at long-term situations. Good corporate dialogue. These take years and years to fructify in general. So not to look at the specific names that you said, I mean, you know, the names get thrown around for every deal that's around. So one has to live with that. But I would say the only thing is that we do work on deals for quarters on quarters on quarters before a deal even takes shape. And even then, getting a deal done is not easy.
Of course.
So, but I think that deal environment actually on balance is becoming more interesting. There's a lot more actionability than before. And just if valuations can correct a little bit more from a selfish point of view, I think you'll see a lot more FDI coming in, a lot more.
I think your prayers will be heard the way the markets are going right now. But also, just finally, in terms of outlook, if you can give us a little bit of sense on how much investment can really come in from KKR in the year 2019 into India.
Again, I don't have a number, we don't have a formula, but look, we, as a private equity and VC asset class, we had an okay year. This year, we brought in about $22 billion, right? Last year, I think, was about 30 for the whole industry. I think the next year, once elections are out of the way, I mean, look, private equity and venture capital, I don't think they care that much about election results. They're much more long-term money. I would be surprised if it's not $30 billion again next year. I would be absolutely surprised.
Right.
And, you know, people like us and some of our peers and some of the venture capitalists who are well settled, well embedded with good teams, I think sky is the limit here.
All right, and with that, on that note, all the best for the year 2019 to the entire team of KKR. Sanjay, thanks so much for your time here on CNBC.
Thanks a lot.
TV18.
Thanks, guys.
All right, with that, it's a wrap on this edition of Big Deal, but keep it with CNBC TV18.